The Fed just reset the market. When Federal Reserve Chair Jerome Powell spoke about resuming housing construction in June, it sent shockwaves across the country because it sounded so ominous. Finally, at the last FOMC meeting held recently, Powell clarified what he meant by the term and what the housing rollback meant to the Fed. So will the Fed's plan help in a recession? And what's the Fed doing? To know the full news, keep watching the video. Meaning of resetting the market. In June, Fed Chair Jerome Powell announced his plans to reset the housing market, seeing the possibility that house prices will fall. When Powell was asked for clarification of what reset meant, he issued a lengthy statement. When I say reset, I don't mean a specific data set, Powell said. What I'm saying is that we're facing a fluctuation in housing periods across the country where high-profile homes are selling to buyers for 10% over the asking price before the house is even in sight. So there is a huge imbalance between demand and supply. Homes are growing at an unsustainable pace. As the Fed raised interest rates to tame inflation, the housing market started to slow down. The so-called reset or housing correction is intended to spread throughout the economy and reduce inflation. When mortgage rates rise, home sales fall, which also causes the demand for durable goods and services to fall, which in turn weakens the labor market and ultimately limits inflation. In the long run, supply and demand must be better matched for house prices to rise at a reasonable rate and a reasonable pace for the people to buy homes again, Powell continued. The housing market has gone through a correction to come back to where it is. While Powell would like to see a reset to a more balanced housing market, an aggressive push could result in a contraction in housing construction, which could lead to an increase in the housing supply deficit, the opposite of what was intended. As you know, right now it's hard to find land near cities, so builders are having a hard time getting zones and land and workers and materials and things like that, said Powell. But if we look from the perspective of the economic cycle, a tough correction of the Fed could bring the housing market back into a better situation. Federal Reserve to increase rates by 0.50%. The Federal Reserve said it would raise interest rates by 0.50 percentage points after its December 13 to 14 meeting, bringing the federal funds rate into its target range of 4.25 to 4.5%. The move ends a year of aggressive interest rate hikes by the Federal Reserve to quickly drain liquidity in financial markets and curb high inflation. The Fed's decision came as inflation continues to hit the U.S. economy at some of the highest annual rates in 40 years, reaching 7.1% in November after peaking at 9.1% in June. As the Federal Reserve slams the brakes on an overheated economy, the main question for many market watchers will be how many more rate hikes and how deep the next recession could go. In addition to raising interest rates, the Federal Reserve has also sold a large portion of its bond portfolio, most recently doubling its monthly sales to $95 billion in September. When the Fed depletes its balance sheet, this move helps drain liquidity from the financial system to curb inflation. At around 3.5%, the 10-year Treasury is already well below the 52-week high of 4.33%, which only hit in October. This decline in yields, even as the Fed continues to raise short-term interest rates, suggests investors are bracing for a near-term recession. What do you think will force the Fed in improving the housing market? Stock markets rallied as interest rate of Fed was near zero. Stock markets rallied as the Fed kept interest rates near zero for a long time. Low interest rates have benefited equities, making them appear to be more attractive investments compared to bond yields and fixed income investments such as CDs. Investors have been expecting rate hikes since late 2021, and the S&P 500 spent most of 2022 in deep declines. And now with short-term interest rates soaring even higher, investors are wondering how high they can go and how low stocks can fall as a result. For most of 2022, higher interest rates hit bonds hard, depressing their prices. The longer the term of the bond, the more it is affected by rising interest rates. Now that investors are starting to see an end to the Fed's aggressive tightening, bond markets may start to find a bottom, but with the economy yet to emerge from the expected recession, stocks could still fall. Now, short-term interest rates are much more attractive if you're looking for a safe place to store money while waiting for things to cool down. The continued streamlining of the Fed's bond portfolio will likely further reduce support for stocks, bonds, and even cryptocurrencies. Bottom line, inflation has been heating up in recent years and the Fed has aggressively raised interest rates to fight it. So plan carefully how you can benefit, for example, by being more selective in buying installments for your savings or CDs. One option for those seeking protection from inflation is the Series I bonds, which now offer a solid annual yield of 6.89%. So, this would be it for today. Hope you enjoyed watching the video.